Good morning and welcome everyone. I'm Tom Bowley, Chief Market Strategist at earningsbeats.com, and this is Trading Places Live. It is Thursday, March 12th, 2020, and today we got a little bit of a mess on our hands for sure in the markets. We've been seeing a lot of fear building. We've seen a lot of big drops in the market. Likely to see another one today at the open. We've got futures overnight hit the lock limit. So that was down around 5%. And the last time I looked, and I'm going to check it for you right now, one of the things I do is go into the symbol summary at StockCharts and just pull up the key movement or the key ETFs. And when I pull up the Qs this morning, the QQQ, it is down 5.88%, down $11.47. And the Spider is down 6.55%. So that's down 17.96 to 256.40. So that'll give you an idea of where we're looking to open. It's not going to be pretty today as it's been throughout the week. We've seen a lot of selling around the globe, and that is certainly carried over here into the U.S. And like I said, we're going to get off to a rough start this morning. Let's go ahead and go over some of the things that we're going to talk about today. And we'll go ahead and start with the daily market recap, which is what we always do to start. We've got talking technically. I want to look at these fear levels again. I've spent a lot of time talking about the VIX. I'll show you where we are now versus where we've been in previous major downturns in the market to give you an idea, the sense of the level of fear that's in the market. In addition to the VIX, we'll take a look also at the equity-only put-call ratio. And again, just show you where we stand now versus where we have stood at prior bottoms in markets, major bottoms. So I think you'll find that interesting, especially if you haven't followed it in the past. Then we'll get into earnings spotlight. Not really a whole lot going on, and quite honestly, I don't think the market right now is really focused too much on earnings and companies. Many companies have been withdrawing guidance going forward because they just really don't know what's going to happen. And that's, I think earnings and upgrades and all of that. I don't know. I was looking at some of the upgrades today, and we're going to go over upgrades and downgrades. And the 4 upgrades I have, they're probably down an average of about 7% today. So even upgrades really just being overlooked at this point. I don't think the market's paying any attention to anything except responding to fear. And unfortunately, that leads to very impulsive selling. So we get these bouts of impulsive selling where the market just goes down, and if we're looking at the Dow Jones, hundreds of points in fairly short periods of time, big gap downs. That's been the norm for the past few weeks, and I suspect that for the next couple of weeks at least, we're going to continue to see that volatility. The question is whether or not the market begins to rebound. But after going through upgrades, downgrades, we'll finish with 3 you must see. And today I'm going to really just focus on 3 of the worst performing industry groups over the course of the last month. You can probably guess 1 or 2 of these, but we'll pull up the charts, take a look at just how much damage we have seen there. All right, let's go ahead and get started with the market recap. It was not a pretty day on Wall Street. Another big gap down to start the day. And then the selling did actually continue. We haven't seen a whole lot of follow-through selling, but we did see some of that yesterday with the market closing down near its lows. The Dow Jones Industrial Average down almost 6%, down close to 1,500 points. This seems to be the norm. It used to be you had a 1,000-point down day. That was a bad day. Now it seems to be that's kind of the norm, and maybe even a little more than that. The S&P 500 down almost 5%, 141 points. The NASDAQ down 4.7%, down almost 400 points. Mid caps and small caps doesn't seem to matter. Up day, down day. They have been lagging, and they did it again yesterday, even with a horrible day. Mid caps lost 6.6%, small caps just over 6%. Not good. As far as all the sectors go, we saw a lot of the aggressive sectors leading the market rally a couple of days ago when we came, roaring back late in the day. They finished near the high. That was not the case. We actually saw a lot of that reverse yesterday. Industrials leading to the downside, down almost 6%. Consumer discretionary, 5.5%. And financials just under 5.5% lower. Real estate and energy wound up the worst 5 sectors yesterday, both dropping a little over 5%. So all in all, all 11 sectors again down, and this has been very thematic of this whole process over the last few weeks, it's been what I just referred to as indiscriminate selling. Doesn't really matter. Everything's going down. There are pockets of strength, certainly on a relative basis. Gold mining shares, those are all performing on a relative basis better, but just about everything's going down. You have some stocks, individual stocks, especially in the biotech healthcare area, that are maybe feeding off the coronavirus a little bit because they're looking for a vaccine, or they've got partnerships dealing with the virus. And so we are seeing small pockets here or there where there's some strength, but otherwise, for the most part, it has been indiscriminate selling. Just sell everything. Taking a look at the 10-year Treasury yield. First of all, we did have initial jobless claims out. Again, I don't think the market cares right now, because the market really is looking at what this virus is going to do over the next 6 to 9 months to our economy. So initial jobless claims came in very strong this morning, better than expected. 211,000 versus 216,000. But I think most economists would agree those numbers are probably going to start to go up in the coming weeks. We'll see. But so far, so good on that front. We got another inflation report out at the producer level, and the numbers were very, very weak. February PPI dropped 0.6%. The market was expecting a flat reading. And if we move to the core producer price index, core PPI, we saw a drop of 0.3% versus the expected rise of 0.2%. So inflation continues to come in way below expectations. It's well below the Fed's target level, which gives them ammunition if they want to continue lowering. Not a problem on the inflation front. And with the slowing economy, I think when they do meet next week, I think you're going to see a pretty aggressive cut and action on their part. Let's see, what else do we have? Well, let's give you an update here on the 10-year Treasury yield first. So right now we are at 0.67. That's down 0.15 or down 15 basis points. You know, the one thing that surprised me yesterday was that money rotated out of treasuries. You can see the 10-year Treasury yield actually went up. That normally coincides with really strong action in the equity markets. It did not yesterday. That's one of the few times I would say in recent months where we've had a nice pop to the upside in the 10-year Treasury yield without any corresponding pop to the upside in equity prices. I think that just kind of tells us a little bit about where that fear level is right now. All right, speaking of fear, let's move on to talking technically. I want to talk a little bit about the S&P 500. I'm going to go back 20 years. And so what I have here on this chart, actually, let me make the VIX and the equity only put call ratio just a little bigger here on this chart. So this will give you a really long-term perspective. This is a daily chart. I'm not really trying to find individual moves in the S&P on a daily basis. So it's just kind of showing you where the big moves down have been. End of 2018, 2016 on the breakdown, 2010 and 2011, little mini pullbacks there. Well, more than mini pullbacks. There were pretty big pullbacks coming out of the big bear market of 2007 to 2009. You can see those lows. The lows of the 2000 to 2002 bear market. And what I've got down here at the bottom is a 5-day moving average of the volatility index. So the volatility index is the expected volatility, and its calculation, I'm not going to go into it. You almost need a PhD in math to go through the calculation. But essentially what the VIX looks at are short-term S&P options. And basically it's looking at the premiums that you're paying. So there's a premium on options based on time, but there's also a premium based on volatility. When the market is really volatile and moves wildly back and forth, options are much more expensive. And it's those more expensive options that drives the volatility index higher. So anytime you see the VIX rising, it's telling you that the market is growing in volatility, and as a result, it's expecting big moves in the market going forward. And as a result, options are being priced more expensively. So you can see the VIX 5-day moving average now at 47. When we look back in history, there was only one time where we saw the 5-day moving average of the VIX get to 47. And that was back in this 2008-2009 crisis. I mean, I guess you could say there were two periods. One was the actual real financial crisis when we were having Lehman Brothers going under and all that, that occurred back in October of 2008. And then the one final drop that we had in March of 2009, you can see the 5-day moving average was still hovering around 50. Currently, we're at 47. After today, maybe that number's up in the 50s. I'm not sure. It could actually exceed the March 2009 level. But this is a very, very high reading, no matter what you're looking at. Again, with the exception of that huge move, and maybe we're going back there. I mean, that was a 5-day moving average of the VIX that went over 70. That would, I don't think we go there, but hey, I didn't really think we'd get here, to be honest. So, the market does its own thing. Very difficult to try to predict. What I can tell you, though, is when you're looking at these big major peaks in the VIX, they coincide with major bottoms in the market. This is going to coincide with a major bottom in the market. The question is, where is that bottom going to come in? Now, I was writing to members and looking at this 27. I think there was a low close, or I can't remember if it was close or intraday, around 27.22. I think it was intraday. And so there was 27.22 to about 27.34. If you looked at the recent closes, I think the lows from just the last week or so, we got down to about 27.34, I think, on 2 occasions. And then we had a couple of lows back in, I want to say maybe March of 2019, and then again in May or June. I think it was June. But those lows came in at, I think, 27.22 and 27.28. Yesterday, we closed at 27.41. We hit a low of 27.07, which took out those lows. I really wanted to hold that level, but with futures where they are today, unless we get a big, big reversal today, it certainly looks like we're going to bring that December low into play, December of 2018. And that would be down around the 23.50 level on the S&P 500. That would be another 400 points from where we are now. I'm not suggesting we're going to see that today, but in fact, I don't think it would even be, well, I guess it could be possible. You've got the triggers, the circuit breaker triggers that go into play at 7%, 13%. And then if the market were to go down 20% in the day, the market closes. So 20% from here would be 540 points, which would take us below that level. I'm not saying we're going to go down there. I'm just giving you different levels that the thresholds, those circuit breaker thresholds would kick in. All right, so this level 23.50, and as far as I'm concerned, with the big gap down today, that is definitely in play now. I didn't know if we'd go down there. I didn't think we would, but there's really nothing else to stop from a technical perspective. So it's going to be a capitulatory, throw in the kitchen sink kind of a bottom that's going to need to form before the market can stabilize. And like I said, the VIX getting up 5-day moving average into the upper 40s is getting high. Look at the equity only put call ratio. This is the 5-day. Remember a month ago, we were heading into options expiration. And by the way, options expiration is a week from tomorrow. And there are a ton of in the money puts right now, which would favor a rebound, if for no other reason, for options next week. Now, we're still 6 trading days away. I don't usually look at it that far out. But if we're still sitting here like this come Monday, Tuesday, Wednesday of next week, I would not put it past a couple of huge gap ups to wipe out a lot of in the money put premium. But that's something for next week. And we're probably, actually, I think we have at Earnings Beats, we have a webinar scheduled to talk about that, to talk about max pain. And as you head toward options expiration, the whole idea of market makers really benefiting if we get reversal. So that's something you may want to mark your calendar. I'll be talking about that more next week. All right, but going on to this put call ratio, look at this reading right now. 5-day moving average is at 0.91. What this means, it's the number of puts, equity only puts divided by the number of equity only calls. Most traders trade calls. A lot trade puts, but most action is on the call side. And most action on the call side is on the long side. So, when we see equity calls being traded, we don't know that somebody's buying a call. They can be selling a call. But the overwhelming majority of option traders, the last statistics I read And that was a few years ago, a couple years ago. But the overwhelming majority trade options on the long side. So when I look at this 5-day moving average, what this tells me is that there's almost as many puts being traded as calls. That's what 0.91 means. If it gets up to 1, that means for every call that's being traded, a put's being traded. And when you look at this 5-day moving average reading, we've gone up above 1 only twice in our history, 5-day moving average, since we've been tracking the put-call ratio back in 2003 here. That was in 2008, financial crisis. So when we had that extreme fear on the VIX, we also had the extreme fear on the equity-only put-call ratio. And when you look at this, getting above 0.90 is, doesn't happen often. We saw it just get over 0.90 in December 2018. At the end of beginning of 2016, when it looked like we were breaking down below these prior bottoms and rolling over, we saw it jump up to about an average of 0.93. 2012, 2011, you can see some pullbacks here that showed fear. And then, of course, the 2008 level. 2004, there was a little bit of fear coming out of that bear market as we pulled back a bit. But that's it. In history, going back the last couple of decades, we're at some pretty high readings. And so if you're looking for high fear, high volatility, everybody buying puts, throw in the kitchen sink, we're getting there. I can't tell you if we go higher. What I can tell you is that I wouldn't be shocked if these readings mark bottoms. Could we go a little higher? Yes. And if we go higher, the problem is, and this is the problem when you're getting in trying to time a bottom, with the VIX at this level, if you miss by a day or two, you can kind of see what happens. I've actually started getting back into the market, mostly with the QQQ and the spider, and I'm just kind of getting in stages as the VIX continues to spike. But just starting to get in here over the last couple of days has already not been a really good thing, especially after yesterday with the futures down this morning. But it's a process. These bottoms, sometimes they just go down and quickly right back up and we have a V bottom and it's over. But normally it's a process. You go down, you bounce, you go down, you bounce, and then you settle down, and then hopefully with a double bottom in play, you break out and you end it. But we got a lot of work to do before we get to that point. All right, let's move on to earnings. And the first thing I want to look at is a report out from Dollar General this morning. They did beat estimates, $2.10 versus $2.02. When I looked, and actually we can look. Again, go to symbol summary, and I'll show you that QQQ, by the way, so we can see where we are right now. 6.46, so we are continuing to move up on the QQQ. Let's see if the spider has hit 7. 6.98%, almost 7% at the open is what we're looking at. Another big down day on the open. Dollar General, you can see pre-market down 2.3%. So on a relative basis, not bad. But this is what I was saying. Even if you come out with a good report, they beat at $2.10 versus $2.02. The market still doesn't care. Still going to go down. This is a stock, though, that just a couple of days ago, you can see on this chart, was trading very close to its recent highs. So if I pull the chart up, we take a look at that. This was yesterday, which was Wednesday. So that's Tuesday's candle, threatening to break out on Tuesday. So on a relative basis, I don't have to tell you how strong this chart has been. Here is the relative strength versus specialty retailers. Here is the chart and the relative strength versus the S&P 500. Very strong, and you can see specialty retailers have been holding up extremely well. All right, let's see, a couple other earnings. Let's move on to, let's look at WPM. Now, when you look at the chart, wheat and precious metals, and I'm going to pull it up on a relative basis. And it is in the non-ferrous metals group. The group has been coming down, but this stock's actually been one of the better stocks within the group. So it's been outperforming the S&P 500 throughout this coronavirus period. So last month when we really got hit, you can see on a relative basis, WPM has held up pretty well. So the good news is that on a relative basis, WPM looks pretty strong. The bad news is did not fare well after earnings. So it is currently down 17.79% this morning at 22.79. So we pull the chart up, 22.79 is way down here. We're going to clearly open way below these prior lows. I think this opens up the door to the May lows down just below $20. But where it goes after it opens is anybody's guess. It's going to be a huge gap down, but then you've got market makers on the other side. So while everybody's selling at the open, they're on the other side buying. So a lot of times you will see an initial push back to the upside. That's something maybe to watch for. SMTC reported last night after the bell. This is Semtech Corp. Big move down with the coronavirus. You can see a huge drop taking out all these prior lows on a relative basis. On a relative basis, you can see the group, the semiconductors, have obviously been pulling back quite a bit. The stock has been a very, very weak performer versus semiconductors. Semiconductors, this still is kind of surprising to me. I'm seeing, semiconductors, computer hardware, software still hold up pretty well on a relative basis. Not quite sure how to interpret that. I want to interpret it bullishly, but waking up to futures down 5 to 7% each morning, it's hard to hang on to that bullish theory. But semiconductors on a relative basis are trading above lows that we saw back at the end of January, throughout January. And actually, you could even argue there's a little bit of an uptrend in play versus the S&P. So semiconductors holding up not so bad at this point. Now, SMTC specifically, if we look at the pre-market action, stock down only 1.72%. They did beat, by the way, 40 cents versus 35 cents. I don't think I told you on Wheaton, precious metals, WPM. They matched estimates, 17 cents versus 17 cents. So SMTC actually beat 40 cents versus 35. It's down 1.72%, but that's better, much better than what the overall market is doing this morning. And again, if we go back, look at that chart, you can see that probably it's going to open at a new low. We have to go back even further. I'm going to go back a few years here and just see if there's some other support levels. Yeah, it looks like back in 2018, $32 seems to be a really good support level on the stock. And we're probably going to get down and maybe get close to challenging that early in today's session. So that's something to watch. All right, upgrades, downgrades. Let's take a look at Akamai to start off. Akamai has been upgraded. And I got to, I put on this chart the accumulation distribution. I've been using this a little bit more recently because everything's going down. Everything's going down a lot. But accumulation distribution should follow price action. And we've come down a lot on Akamai, and yet the accumulation distribution is turning higher and about to break to a new high. And I explained this over, I think, at Earnings Beach yesterday. But if you're not familiar with accumulation distribution and on balance volume, I'm going to pull up on balance volume and show you this on this chart. It should be looking a lot different. These are similar kinds of indicators. On balance volume, if you're down for the day, if yesterday you were $87 like Akamai is, let's say you're 87, and the next day you open at 83 and you close at 86.99, on balance volume looks at that and says, well, you were down a penny for the day, so it moves lower based on that down day. Accumulation distribution looks at how you finished that day relative to your low and your high. So if you're above the midpoint of that candle, so these hollow candles that you see where you're closing near the highs, those are all positive for accumulation distribution, but they're negative for on balance volume. So you start to see this divergence. And so some of these with the big gap downs and then buying, who's buying, with these big moves to the downside at the very open, and then seeing all this buying, a lot of this buying throughout the day. Akamai hasn't had a really bad, big red candle since probably back on February 25th. We've had a lot of gap downs, but these hollow candles mean that there's buying throughout the day. Anyway, I thought that was interesting. Wanted to point that out. I'm seeing that on a lot of charts. And I don't know whether to think that maybe the markets are being manipulated or if that's just the way this is going to be. And we're going to continue moving lower like that with these big gap downs. I don't know. Be interesting to see whether or not we recover today with this huge move down at the open. One downgrade, and then we'll get into the three you must see. Let's take a look at American Express. American Express being downgraded today. By the way, Akamai, even with the upgrade, stock is down 6.43%, or it was 30 minutes ago. Might be more than that at this point. Before we look at this chart, let me show you AXP, and we'll get the reading there. Down 8%, being downgraded today, so it's down to 87.69. This was Akamai, down 6.7%, so it is down a little bit more. All right, going back to American Express, so it's 87.69 right now, pre-market. And so that is obviously going to take it way down below. We're going to probably have to go back here a few years. I'll go back 5, see if we can get some support levels. December of 2018 and February of 2018, I would say between 85 and 90. And what were we, 87 and change? So we're gapping down into a really big support level on American Express, something to consider. All right, let's go ahead and take a look at the three you must see. And I'm going to start first just by showing this is a 1 month relative. It's a chart list that shows all the industry groups relative to the S&P 500. And then I went back to the period and set it for 1 month. So you can see which groups are the worst performers. The three I'm going to look at today are number 3 on the list, recreational services. Number 4 on the list, which is an energy area of the market. And then aerospace, Boeing. Just, more bad news that coming out of Boeing today. They're freezing new hiring and overtime to preserve cash as the coronavirus adds to all of their prior 737 Max Plane, well, it is Max Payne as well. Max Plane issues that the company's been facing for the last several months. And so it's just not been good in that area. But let's take a look first at the aerospace. So here is your relative chart to the S&P 500. You can see it dropping right off the planet. It was already bad. This was a group that was already lagging before all of this hit, and now this is just adding another layer of selling. When we look at the absolute chart, which is down here on the bottom, you can see that December 2018 low is lost. So this is a group that definitely is running into some big time troubles. It's a group that I really would avoid. I'm not a big fan of a lot of groups out there right now, but this is certainly one that I don't like trying to catch that falling knife. And this is one where the knife is definitely on a fall. The second one I'll go over is DJUSOS, which is the Exploration and Production Index. Same type of thing, already in a downtrend, and then just added more fuel to the fire with the crude oil prices dropping the way they've dropped here over the last week. But a big breakdown below these prior lows. This is a 3-year weekly chart, so you can see really huge drop. Again, I personally would stay away. I'm not trying to catch this knife. And then the last one I wanted to show you is the recreational services. And you've got different companies within this. Clearly, the cruise lines are the worst area of this. But just thinking about recreational services with a coronavirus scare, people not really wanting to go out, this is an area that's going to take a while to recover, unless all of a sudden we have a vaccine that comes out. But here you can see the big drop on a relative basis. Again, already downtrending before this. This is just adding to it, and then the huge breakdown on the absolute basis. So we got another rough start coming up. We're going to be looking at probably 7% down on the open, so we may have another 15-minute delay based on that. So I want to wish everybody luck out there. Happy trading. I'll see you all next week. Take care.